You have now arrived at your destination.
Oren, this is such a joy for me to do. As we chatted about before, third-time guest. This is very, very rare, but there's always so many things that I bluntly learned from our conversation. So thank you so much for joining me today.
My pleasure, yeah.
I would love to start, Oren. For those that missed our prior episodes, first off, 1 to 2 minutes, how did you make your way into the world of venture before we dive in?
So I started as a double engineer, started as a research fellow and then a research staff member at IBM. Got a business degree, got back to Israel. I didn't say I was born and raised in Israel. It was 1994, and the whole venture industry literally started overnight, and the whole industry was 10 people. And I was lucky enough to be hired by Apax, who wanted to open operations in Israel, one of 2 people. That's how I got into venture. I spent 12 years with Apax, the first 7 years in Israel, and then they asked me to move to the US and strengthen the US operation, which I did. I moved to the Silicon Valley 20 years ago, 2002, and for about 5 years I was heading their tech practice, and then I retired or got fired, and then I really started the the interesting part of my career, which is doing it my way on my own.
Totally get you. And what a journey it has been doing it your way on your own. And I mean this question respectfully, Oren, but you're a little bit more seasoned than me. You've seen a few more crashes than me. When we look at where we are today, what's different and what's the same about the current crash? I'm fascinated given, you've seen 2008, you've seen the .com. How's this different? How's it the same?
Well, it's very different from the .com, which was really nuclear, because back then, it's not just the valuations collapsed, and really collapsed, not 50%, 95%, but it's also that the businesses collapsed. There was no business. You could be selling to a certain segment of the market, and overnight, all your customers basically go out of business, for example. So that was something that I think is 1 in 100 years, hopefully. I hope I never see anything like that again. 2008 was not as nuclear and big in terms of the tech industry. It was maybe bigger if you look at the overall maybe effect because it wasn't specific to tech. Unlike 2001, it was specific to tech. 2008 was much more general. So on many aspects, it's worse. But in tech, it was not as bad. But still, there was a lot of real pain. I think that today, valuations were cut by 50% in the public markets on average, but most of the businesses are still going very strong. Most of my companies, we don't see necessarily any weakening of demand. And some companies decide to grow a little bit slower because they want to maybe reserve a little bit more cash. But the fundamentals are there, the fundamental demands. If there was a healthy business before, it's a healthy business now. So I don't equate the current crisis to those 2 big ones.
Oren, when it was the .com, you were pretty early in your career then. We have many people pretty early in their career seeing this for the first time. How would you advise them in terms of managing their investor psychology? And how did you manage yours early in your career, seeing 95% drops?
How would I advise? First of all, I think every crisis is different. So I think, I was in that, just like every war is different. So, you say, I was in this war, therefore, it never works. So I don't think there is, necessarily like a recipe from previous crisis. But personally, I can tell you that every single deal that I did in 1999 tanked. Was a bad deal, and every single deal, really 0% success. And really what helped me back then is not to be overly obsessed with the mistakes that I'd made and just basically start over, and I moved here in 2002. The first deal that I did off the bat was Audible, which was a big success. So, it's not about saving the, don't over obsess about saving. It would be my advice. If something's not working, just not, by the way, it's a good advice regardless of crisis, If something's not working, no need to overly obsessed about it and make the life of the founder miserable more than it has to be. And just be positive, help if you can, but not obsessing, and just focus on the future.
I love that. And I totally agree in both the good times and bad, that mentality. I do want to start, and we're going to kind of deconstruct a load of different elements, a little bit kind of borrowing from the article in The Information, which I loved. But if we start with the cadence of deployment, this was a striking one. Raising a $500 million fund less than a year post the last one. It's pretty unprecedented, Oren. I mean, the deals are fucking fantastic, but it is fast. How do you answer the question on speed of deployment?
First of all, it's even faster than you think, because in 2021, I raised 3 funds, total about $1 billion, and then now I'm raising another $500 million. And I don't keep reserves, so I invested it all. I don't try to manage the pace at all. So I just try to do great deals when I see them. And if I don't see them, I don't want to do them. So I don't want to miss a great opportunity just because I've invested a lot of money in the past 3 months. And likewise, it's theoretical because it hasn't happened, but let's assume that I can't find a good deal for a year. I wouldn't want to do it make an investment just because I haven't done one in a long time. So I just do not, and I tell LPs, if an LP asks, at this point they don't ask, but if they do ask, I just tell them, I just don't try to manage the pace. It's totally opportunity driven.
So I was brought up.
Deal with it is my answer is deal with it. That's my answer.
But I totally get that, and it's for some LPs and not for others. I was just brought up strategically on the temporal diversification is the way to build great portfolios. Yeah. Am I wrong? Was I sold a dream that isn't true, Oren?
I don't want to say that. Yes, I think you're wrong. At least I don't think the same way. I had. I think after my 3rd fund, I had an LP who joined in the 3rd fund, and 4 months later, I tell him that, I'm raising now Fund 4. I finished. I'm raising, and he totally freaked out, and he started lecturing me on. He didn't call it what you called it. He called it vintage diversification, but I think it's the same thing, same idea. And I started to lecture me, from all, and I just, long story short, he's not an LP in 4, and he's not been an LP ever since. He's not going to be invited ever to be an LP in Zeev Ventures. It's just, again, it's the same answer. I just do good deals. I don't want to think about portfolio construction and vintage diversification, all that. By the way, I would say that in this case, actually, from an LP perspective, what do they care? If I raise a fund every year, and they just are in every fund, they do get the, even if one fund is not what he called vintage diversified, they would be vintage diversified if they care about it. I don't care about it, but if they do, they could just invest in every fund. But anyway, in this particular case, I think he was too obsessed with this concept. And because of that, he missed out on all the great funds that followed Fund 3.
I mean, the reason they have a problem with it is, as you know, they have budgets and they have set allocations for Zeev Ventures. And when you come back after 4 months, you're fucking up their model.
So hence my answer before, deal with it. But,
I totally get you. Does the state of the market today impact that deployment pace? I have to be honest with you. I am sitting here going, you know what? 8 out of 10 deals that we might have done, honestly, we're a very diversified fund, unlike you, actually. We're not fucking doing now. It has to be a 9.5 out of 10. And so the bar's just gone up for us. Has it changed your style of deployment?
It hasn't changed the way I make decisions. It hasn't changed anything for me, but I'm not immune from the market. I'm not in a different planet. And in my case, by far, most of the money is actually being invested in follow-ons into companies I'm already invested in. And the pace of these follow-ons has dramatically come down, because in 2021, everyone rushed to raise more and more capital, because every few months you could double the valuation and people rushed. So, that's the pace of these follow-ons was very, very fast. Now, most companies, even the ones that are doing great, most of them are flush with cash. They don't have any reason to hurry to the market. Why not build more value before they go back to the market? So even if I continue to invest at the same pace from a new investment standpoint, that's only about 20% of the cash that I invest. 80% goes into later stages of companies that I got in early. And in those, I think these follow-on rounds are, much slower, fewer and much farther between. So yes, it's gonna. I assume it's gonna impact. I expect it to impact my my pace, but not because of some strategic decision of mine to slow down, or not because I'm trying to manage it. It's just that I expect the market forces to dictate it.
My biggest misses have not been ones that I haven't done. Well, I mean, other than Riverside, but it's been one. Fuck. But it's been ones where I invested, but I didn't double down because I thought the price was too high. It's too high. It's ridiculous. Yeah. Now, you mentioned there they come back because they can, and you concentrate capital incredibly well. But my question to you is, how do you determine whether it's a stretch or a stretch too far on the price that they're asking and what you're willing to pay?
So first of all, I don't make a huge distinction. I don't make a real distinction between a new deal and a follow-on deal, because each deal should have, stand on its own merit. I believe. So, in general, I don't think one should be overly price sensitive. Obviously, you have to have some discipline, but the reality is that if you're dealing with companies that are growing at over 100% per year, and you believe it's sustainable, okay, even if you pay up, let's say by 50%, pay more than you should have by 50%, it will catch up in 6 months, right? So it's not a big deal to have paid more for something that or you feel, or you believe that is going to continue to grow fast and for many years to come, and has a great and is going to have a great outcome. So I guess so I would rather make the mistake of paying a little bit more than if I have confidence and conviction about the other metrics. I would rather make the mistakes of paying 50% more than maybe I should have based on some comp analysis than miss out on the opportunity.
What happens when you lose faith in the entrepreneur? It sometimes happens.
Yeah.
What happens when you lose faith?
So first of all, I want to be as transparent as possible so that they're not surprised. And by the way, it doesn't even matter if it's losing faith in the entrepreneur or just losing faith in the business. It's not the same. I could still believe in the entrepreneur, but just think that this business, I don't see it succeeding. And in that case, thankfully it doesn't happen often, but it does happen. I'm just being transparent with the founder, and I tell him, listen, I don't think we're going to be able to raise. I'm not going to carry this on my back. I'm not going to continue to back. I don't think you should continue, because the founders are also investors. In fact, they invest something more valuable than money. They invest their time, which is more valuable than money. And I think when you're coming from a place of authenticity and candor, at least in my experience, founders react very well to it. Not from a place of blame. Should have done this. You should have done this. We tried. You gave it 110%, sweat and tears and whatever else Churchill said, and blood, I guess, and. It doesn't seem to be working. Not everything has to work, and there's no shame in it at all. I don't have to say it, but non-verbal it comes out, and in my experience, most founders, at least in my case, all of them that I can think of, are really mature about it. I just had this conversation a few weeks ago, and, a company that actually we thought, I told him I'm going to support the company. By the way, I didn't lose faith in the entrepreneur, I wasn't sure enough in the business. I told him, listen, I'm going to support the company, but I'm not going to lead it if nobody else does. And we were surprised that we didn't get the reaction that we expected. It was harsher than we thought. And, we decided to just try to sell it. And now we're trying to sell it, and we'll see. But if we cannot sell it, then we'll shut it down, And, I believe that sometimes you can, the analogy that I use sometimes is that, you probably know that 50% of the healthcare costs in the U.S. are spent on the last 2 months of life. Okay, it's crazy, and nobody wins because I was never in this situation, but I'm sure that I would rather live 2 months less than live another 2 months and suffer. And the analogy for the companies is if you decide to give up a month or two too late, the agony and the lack of dignity and the pain is like 10 times. When you decide to stop in time, you have enough time to do it in an organized fashion, to make sure that everyone is taken care of, to maybe even have a chance to find soft landing for the employees. You run it a month too long, and then you owe money here and you owe money there, and the employees are livid with you, and other people are livid with you, and just not worth it. So I'm actually not a proponent of making it or die. I think it's okay, to give up, like a few weeks before. You don't have to, it's enough that you gave it 99.9% effort. You don't have to do the whole, because the last 0.1% could be very, very painful. So anyway, hopefully we'll get a soft landing for this company, but if not, we don't,
Has a pay to play around ever worked out?
What does it even mean? That someone who's not participating getting wiped out?
Yeah.
Has it ever worked out? I have to think about it. I have to scratch my head. Yeah. It's usually...
One that I'm fascinated by, and it was brilliant in the information article, which was, the mention on ownership. I obviously interviewed tons of VCs, Oren, as you know, and many of them say to me, Harry, ownership actually doesn't matter today because outcomes are so much larger than they ever were, and so it doesn't matter. How do you feel about that and the importance of ownership today?
No, I never focused on ownership per se, and that was the focus of the information, not of mine. I wasn't, they were just very, very, very focused, and to the point of obsession with that point. And they really, really focused on that point. If I'd written the story, I would have focused on other things. I don't think ownership, to me, it was never important per se. If I thought that, a 1% ownership in a company can, move the needle, then I would do it, So to me, the question is a success, in the case of success, is it going to move the needle or not? If it's not going to move the needle in case of a success, then one shouldn't do it regardless of the ownership, and vice versa. There is some correlation, but so I'll give you an example. I had an opportunity when Uber Freight spun out of Uber. I had a very unique opportunity to get ownership, and the ownership to buy ownership from Anthony Lendowski, the guy who allegedly, or not allegedly actually, because it was already litigated, stole the technology from Google, and it was 3% of the company, and I was very happy to do it, and now I probably own less than 2% of the company because I got diluted sense. And I'm still very happy to have done it because I think it's going to be double digits in billions outcome when it goes public. So I don't have any hard and fast rules. I think it's silly that VCs have these hard and fast rules. In fact, this is one of the fallacies of the industry. You see VCs that would fight. They have, in their mind, there is like a number. Let's say it's 20%. And they would fight like crazy about the difference between 19 and 20%, but they don't care if it's 20% or 25%. Why? The difference between 19 and 20 is exactly the same difference as between 20 and 21. What's so special about whatever threshold you decided? The answer is because they operate in some kind of a partnership organization. Organization have rules that don't always make sense because they have to have rules. And that organization decided that the threshold is 20%. So for that individual partner, if it's less than 20%, it's going to be an uphill to approve it. And it's going to be more than 20, and more than 20% is not going to get special credit. So, so he or she, they don't care about the over 20%, but they have to have the 20% so that they don't get, hard questions from their partners when they try to approve it. So I don't have that problem.
Another problem I think partnerships bring, I think they bring arseholes to board meetings. And let me explain that. When a company's not doing well, you, Oren, become an arsehole at the board if you have a big partnership, because you're feeling the insecurity and the weight of your partners behind you saying, Oren, that's a crap deal, that's a crap deal. Whereas for me and you, we have no partnership putting pressure on us if a company is struggling. We can operate in isolation and in pure thought, whereas they can't. I'm interested, that I see daily. For you, where do you see partnership models creating challenges furthermore?
First of all, to your point, 100%. And in fact, I can compare myself because I was 12% in partnership and definitely, it's not that I was particularly an asshole before that, but there's no question that I was more of an asshole then than I am now. Okay, I don't think I was, but more than now for sure. So 100%. And the more insecure the partner is, the worse it is. No question about it. Where else? Look, for example, if you need to approve a deal, being a partner, actually being a VC, it's true for you and me as well. It's always like a triage exercise because every day you see a bunch of opportunities and every day you need to decide which ones you're going to focus on. Okay. If you are the decision maker, you're going to focus on the ones that excite you the most. If you're a partner in a partnership, you're going to focus on the ones that you think you have a reasonable chance to approve. Okay, even if they're not necessarily the ones that So it's easier, for example, to everyone knows that, or everyone believes that the really great outcomes had some element of contrarian thinking in them. But let me ask you this. My point is that it's so much easier to be contrarian when you're operating on your own and you don't need to convince anyone. But if, as a partner in a partnership, I'm looking for less friction, not more. So if something is controversial, it's going to be much tougher for me to decide to focus and dedicate my next 2-3 weeks to try to, push uphill some deal as opposed to something that looks very safe in terms of the ability to approve it because it's a hot space, everything checks all the boxes. It may not be a great deal, but it checks all the boxes that people could ask. So that's another example where I think that, a partnership can drive things more towards mediocrity as opposed to exceptionalism.
You said the element of ownership there in terms of the requirement to have 20% was kind of an kind of BS element of venture models in particular. Are there any other kind of BS elements of venture models that you find interesting that it's good to shine a light on?
Yeah, I'll give you another one. But I don't want to give all my secrets. But I'll give you another one.
It's just me and you, Oren, don't worry.
Actually, we already covered a few, like vintage diversification and... but... general diversification, I think, is a way. I think, by and large, funds are too diversified, and LPs are too diversified in terms of their own the number of their GP relationships. But let me give you another one: the concept of protecting your ownership. Okay. Let's assume that I own 17.3% in a company, and now there's a deal, and it's really important for me, for the typical VC, really important to protect their ownership, meaning to keep it at 17.3. And my question is, what's so sacred about the 17.3%? I just made up this number, totally arbitrarily. If I love the deal, why wouldn't I try to push it and get to 20% or 25%? And if I'm not sure it's a great, opportunity, why would I care so much if I get diluted a little bit? Why would I care so much about putting enough dollars to keep the 17.3 versus say, are these dollars really better invested here versus any other opportunity that I can put this money in, new or full on, doesn't matter. So I think that's another idea that, to me, it's never about protecting the ownership. If I put my money in a company, again, it doesn't matter if it's a full on or new. It's because I want to put money in the. I want to put new money, not because I put something in the past and I want to protect some arbitrary number.
So I think pro rata is BS. I think you should either be in and try and increase to 20 or 25, or be out and have that hard conversation, but be very clear about it. I think
or in the middle, or you don't want to hurt the company. Sometimes you would put maybe more than you would otherwise want to put, but you don't want to hurt the company. You don't want to. So I'm not saying it's that black and white. You have to be because to me the first rule is really to put the company's interest and the founders front and center. But yes, okay, continue. I kind of cut you off.
No, I'm intrigued that you said about kind of people being too diversified.
Yeah,
that did make my ears prick up, because I have this chat with Chalfin. You must be a very good picker, which you clearly are. So, I mean, you've proven it in data. But it goes against the data, Oren. Like 9 or 10 companies in a portfolio is not diversified enough. And it is for you because you're a very good picker. But I don't think many people are I don't think I'm a good I don't think I could do 9 or 10.
Fair enough. I do think that the number of course, it's not an absolute number. I think that the higher the probability of success of the underlying, of each individual underlying investment is, the less diversification you need. If you believe that every deal that you do has 50% chance of being a big winner, then you don't need more than 7 or 8. You probably don't need more than 5. If you believe that probability is only 10%, then of course you need a higher number. So I grant. I concede this point. I would say that on the LP side, I think they're way over diversified because most of them have 20, 30, 40 relationships. That's crazy because each of their underlying investments or funds is also very diversified, is not very likely to lose money. So each, a fund is 100 times less risky than an individual investment. So why do they need 20, 30, 40, relationships? It's stupid. They don't.
Do you know what I think the biggest, most broken thing about LP worlds today is? It's the incentive structures for LPs. I'm speaking to a lot of them who are investing in the biggest brand names, and we don't need to name them, and they have the most egregious terms. And I'm going, what you need to return in terms of enterprise value to get the same that you would elsewhere with these terms is ludicrous. And they go, it doesn't matter, Harry. We don't need to make the money on it. I just get credit for being in this brand name, and then I can use that brand name to get into other firms. And I don't have carry anyway, Harry. I get a bonus and I get a salary.
Yeah, 100%.
Is there anything else you'd like to change?
Especially true for the funds because they also need to use the brand names to raise money for their funds. 100%.
Is there anything else you'd like to change about LP?
By the way, that's great news for the brain. That's great news for the big platforms and the big brand names,
It's genius. The question is, can you elevate yourself and your brand into the hailed territory, which like Paradigm have done, Katie Horn has done. That's kind of it.
Yeah, I personally don't have an issue with raising money from LP, so I don't think about it, so...
Is there anything else you'd like to change about the LP landscape, Oren?
No, I didn't say I wanted to change it. I don't care. Because No, I'm half kidding. Yeah, it would be, it doesn't bother me personally, but it is kind of distorted for sure.
Yeah. No, I get.
Uh, I think that they also, again, this is a huge generalization, obviously, but I think that it's an extremely non-competitive space. I'm talking about the LPs now, because generally speaking, like when you're a VC, you're competing for a deal. If you don't move fast enough, if you're not attractive enough for the founders, they'll go with someone else. When you invest in a fund, because there are many LPs in a fund, and the fund doesn't get raised, even if it's a very hot fund, it doesn't get raised in days, just herding the cats, and there's really no penalty. There's no consequences for being slow for an LP, and they just can have, even if the decision is super obvious, they already know the decision, but they still could take, some of them, like a couple of months, just going through all their processes and memos and whatever they check boxes they need to check. So, and the reason they continue to do it, some of them, is because there's no negative consequences. Because if they're able, because they're even if they take 2 months, they're still going to be in the fund. So yeah, that's another thing that, again, I don't lose sleep over it, but that's another thing that I look at it and say, something must be wrong in an industry where they take, weeks and sometimes more to make a decision that is like, they knew what the decision was before they started to do, the work, and the work has no value whatsoever. It's just that's how we do things. And,
but that's why I always advise managers to put in place deadlines that are not like tomorrow or next week, but are 2 to 3 weeks out. Because if they're not going to make a 3-week out deadline, they're not going to do it. And if they're not going to do it, fucking fine, they can get out now.
Yeah, maybe I don't know. Maybe. The other thing is that anyway, I don't want to stop. Yeah.
No worries. You said about kind of LPs using funds for, to get into other funds and the signaling there. I'm intrigued. One thing that I do get, because I obviously have an early stage and a growth fund, I did get asked a lot about signaling risk. How do you answer the question of signaling risk, given your multi-stage and cross-fund investing ability? How do you answer that signaling risk question?
I think the risk exists, and I take it into account when I make decisions, and I as I said, I never want to hurt the company, and I'm always going to be, I'm never going to say something that's not true. I'm always going to be transparent, and but I'm also, I'm not, it does exist, and one has to take it into account, and I do take it into account.
Totally agree and get you. Final one before we move into a quick AMA. In terms of, as we said, your ability to buy up ownership, it's bloody hard to do. Mostly in your best companies, Sequoia come and take them before you have a chance to, and founders often want that. How do you so effectively buy up over rounds and do it time and time again?
The first principle is always follow what the founders want to do. I never apply any pressure, not even, I never even ask. I'm never even saying, oh, do me a favor. It's really going to help me if you let me put more, because I don't want to because even this I call pressure, I don't want to guilt trip them or anything like that. And I would never say, I supported you when you were, and now, never, ever, So it has to be something that the founders want to do. Okay. And the other thing I would never do is, I would never do it to other funds. If the company I'll never use other funds as stalking horses. So I would never let the company, kind of plan for the company to talk to others, to set the price, and then I'll come in and do it myself. So, whenever a founder goes out, they have to be sincere about it. They should not talk to people just to. At the end of the day, first of all, the only effective way to increase ownership is to preempt and lead the round. If you sit and wait for someone else to lead it, then at best you're going to get to a pro round. Okay. Now, the only way to lead a round is to offer something to the founders that is better for them than the alternatives. Because I don't want them to do it unless they think it's better for them than the alternatives. Now, better doesn't necessarily have to be high valuation, because it's a package. It's the process, the speed, the ease of it, whatever it is. And typically there are, typically there are three situations. One is the normal situation. They go and they do a round. They talk to a few partners, a few VCs. They choose one. They go with them, and then I typically don't get to increase my ownership. The other two scenarios where I do get to increase my ownership by leading a round there are really two kinds. One is that for whatever reason they don't feel like doing a round right now, and they need and they come to me. Either I initiate or they initiate and say, and then either we can agree on something that is going to be good enough for them to just prefer not to do a round, and just do it from me, and then I preempt the round before anyone saw it. That is something that could happen. By the way, it just happened with Riverside, for example, a few months ago. And the other scenario is that they do go to the market, and the market is less excited about the company than they, and frankly, I thought. And yet I think that for whatever reason, I feel that in this particular case, I'm smaller than the market. I don't always think I'm smaller than the market, but sometimes I do in a particular case. And it happened to me twice with Tipalti, for example, that the company went and talked to investors and we didn't get the best reaction. And I stepped in and said, forget it, I'll do it. It happened to me with Homelight, for example. In these particular cases, I had very strong conviction. I felt very strongly that despite the market reaction, I think I know better. Okay, this is the other option. But obviously, it's not always the case. Sometimes the company will talk to other people. The market reaction would not be good, and I wouldn't think that I'm smarter than the market. That's also a possibility. But basically, that's now it's easier to do for me than for a partner in a partnership, because in a partnership it's much easier for a partner to sit back, let someone else price it, get the validation from the outside that they did, that they made a good investment before, and now someone else comes and and prices it at 2x, 3x, whatever, than to try to convince their partners, either before or after the company talked to the market, that they know better than the market and they think it's worth 2 or 3x what they paid a year before. It would be much harder. So what would the typical partner do in a typical partnership? Choose the path of less resistance and less friction. I would have, that's what I would have done. So
I think it's one of the biggest misalignments between like GPs and LPs, which is, bluntly, you look like a hero if you get an up round from Sakura at 4x in less than a year. Why increase ownership when you can use that, raise the new fund off the back of it, rather than increase ownership? I mean, I understand.
But I have the luxury, and I have the privilege, which obviously I earned it. That I don't care how I look to. I don't care how I look to LPs, because I would look amazing anyway. And I don't care if Sequoia or someone else comes in or not. I mean, it's nice. I like them. They're a good firm, great firm. But I don't think it's a necessary or sufficient condition for success. And I don't care about the optics, vis-a-vis LPs. It's also don't feel the pressure to show DPI, for example, for the same reason, because I don't care about the optics, how it look, vis-a-vis LPs, because if an LP doesn't see it, good riddance. Who cares? So I have this luxury that I can ignore this, signal, because it's a false signal. I don't want to take the signal into account. I want to make the best decisions, irrespective of how it looks to LPs.
Do you ever sell secondaries?
I'm sorry?
Do you ever sell secondaries? Speaking of DPI, do you ever sell, get out early if you think, hey, I can take a little bit off the table? How do you think about that?
No, I'll tell you how I think about that. I think that I have a very, very special rule, which is almost always true, which is the ones that you want to sell, you can't, and the one that you can sell, you don't want to sell.
I totally agree. I think that's probably...
So yeah, of course, there are some companies that if I could, I would have been happy to sell, but typically I can't, and the ones that I can, because I get offers all the time in my inbox, would you sell this? Would you sell that? Those are the ones I don't want to sell. So.
Okay, well, so you mentioned Riverside there. Speaking of Riverside, obviously it's like one of my biggest misses, moron that I am. What would you say is your biggest miss, and how did it impact your mindset?
Well, I had my share of huge misses at Apax, not because of myself, but because my partners wouldn't let me, and arguably the biggest one. I cannot be 100% sure that I would have got it because, it was very early in the process and it was killed, super early, but $500 million valuation round of Facebook. I was connected with a company, not yet with Mark, but I was connected with the right person. But before I even asked to meet Mark, I wanted to make sure that I'm not wasting their time. And I brought it to the partnership, and it was, of course, dead on arrival. In fact, I think Chalfen was on that call as well. And it wasn't because of him. A bigger miss in my mind, at least, was again at Apax, where Audible, which I did, I bought 40% of in 2003 and took it public. The company went public again for the second time in 2004, and it looked great. And then the price corrected, and it was clear to me that it was temporary. And I had a chance to take it private at 300 million not pre, 300 million to take it private. And I convinced the founder. I convinced Don Katz to do it, and then I could not convince my partners. Audible today, and instead, a year later, we sold to Amazon for more or less the same price, because I couldn't do it myself. The stake private transaction. This would have been by far the biggest win of Apax ever. Today, I believe that Audible would probably be worth 50, 100 billion. And yes, being part of Amazon maybe help, but Audible is being run independently at Amazon, really independently. You go into their office, you don't see any hint that it's part of Amazon. And so it would have been, I can't say that it would have been exactly the same, but it would have been an amazing outcome anyway. The conclusion from these two instances, especially from the second one, was that I never want to have partners again. Okay, so that was my takeaway. That I don't want to have partners. That I want to own my own mistakes and I don't want to suffer from other people's mistakes.
Where have you fucked up? Like, I don't have the excuse.
No. So I started with this, but of course I fuck up as well. So give you an example. I don't know how well known it would be to people, but there's a company called dLocal.
Oh yeah,
out of Uruguay in payments. And the founder is a very close friend of mine from IBM, 30 years back. He's from Uruguay, but he also lived for 10 years in Israel, and we worked together in the same, next room, adjacent rooms at IBM Research. And then we went to Insight together. So we're very close friends. We've stayed together. And, from the very early days, I was tracking it, and he wanted me to invest. And every time there was another reason. At some point, I was very close to investing. It was clear to me that it was a good deal. And the reason I didn't feel it was the right deal for Zeev Ventures was that he and his partners, or co-founder, really, it was clear, they didn't have this Silicon Valley and Israeli mentality. Oh, we're gonna build this, and it was really, very clear that the minute they can get rid of it, they'll get rid of it like a hot potato. So I said, you know what, I'm investing. I knew it was a great investment. I knew it was a great business, but my fear was that 6 months later they sell it and I only make 3x. That was my risk, that I only make 2 or 3x. And because of that, I said, you know what, I'm going to put money personally, like a small amount. But for Zeev Ventures, I don't think it's the right company. Anyway, 3 years later, the company, they would have sold, but they just didn't get a chance. And 3 years later, they took it public, and the company at some point was 20 billion in market cap. Now it's 5, but I actually made more than 100x on my personal investment. But obviously, I could have got 50. I could have had 15% of that company. I should have. Instead, I let other people did it later at higher prices than I could have got it. So that was, and this is a teachable moment for me, because next time, if the risk is that I only make 2 or 3x quickly, not after 5 years, then I should have done it. And I'll tell you why, because I totally forgot that I could recycle the money. So in the unfortunate quote unquote event that they would have sold and I would have only made 2 or 3 times the money after 6 months, I would just invested it again. I didn't have to pay, I didn't have to distribute it back to LPs. And that was the piece that I missed, because I was thinking, I don't want to reduce my average. And that was a big miss, I think, because I made a mistake for the wrong reason. Sometimes, you look back and say, I should have invested, but in hindsight, I should have invested. But it doesn't mean necessarily that I could have known. But this one I could have known. This one bothers me more than others.
Final one before we do a quick fire. What do you know now, Oren, that you wish you'd known when you started investing and started in venture with Apax over 20 years ago?
That it's all about being the best alternative for the founders. The founders are the customers, not the LPs. And the customer is always right. And we work for the founders. And I think that in hindsight, at Apax, we were not very founder-friendly. I myself got myself into situations of tension with founders that in hindsight were totally unnecessary and counterproductive. And it's all about being the best alternative, having an advantage in winning deals. And the advantage is that the founders prefer you, and they prefer you because of what you do for them and how you treat them and all that. So it took me years to really understand that.
I totally agree with you. My favorite, Oren, which is the quick fire round. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Oh, I don't know. Let's see.
Let's start with okay, what's been your favorite piece of reading over the last few months, year? Could be book, could be blog, could be magazine, you name it.
Wow. Maybe it's perverse, but I really, really enjoyed listening to Bad Blood about Theranos.
Love it. I
know
totally...
it's not very deep. I know it's very shallow. I didn't come prepared. I should have. Come prepared with something more that would make me look less shallow. But sorry, that's what came into my mind.
My friend, honesty is everything. Tell me, what have you recently changed your mind on?
What have I recently changed my mind on? I have a company that I mentally, an old investment, I mentally wrote it off. I'm done. It doesn't have any effect. It's an old fund. It doesn't have any impact. So very easy to walk away from. And they somehow survived COVID. And in the last 3-4 months, I'm starting to see some signs that I interpret as, boy, maybe they're onto something. And so I changed my mind. And they came to their investors with the idea that they need a few more months, so maybe we can somehow find between everyone $2 million and buy them a few more months. And that I don't like, because either you play to win or you don't play. You don't play not to lose. And then I surprised them and told them, you know what, I'll do it, But forget all this. Everyone chips in, and somehow we find $2 million. Forget that. I'll put $4 million myself. I don't care what the others are going to do, and let's play to win. In their case, $4 million is going to, well, it's not going to end as $4 million, because when people saw me put $4 million, it's going to end up as $8 million, and it's actually going to give them an opportunity to actually play to win, as opposed to just survive for another, a few more months. So,
Oren's putting in $4 million. Oh, can we do this? Can we come in now? Oh, amazing, the impact.
And it's a very old fund, by the way. Obviously, this is a very small amount for me today, but it's coming out of a very small fund from the very beginning. So that's why the $4 million is not such a ridiculous number as it may sound. So
I love that. Though. I think it's I hate the bridge to nowheres, as you say there. Which
exactly.
Tell me, what's your biggest advice for first-time fund managers today?
The first advice is what I said before, that the customers are the founders, not the LPs. And I'll tell you why. If you have access to the best founders, you'll also get the LPs. If you have access to LP money, the founders don't care about it. It's not going to give you any edge. They don't care who your LPs are, so the objective is to be the most attractive to founders, because in turn that will give you an edge. In turn that would give you performance. In turn that would get you money from LPs, and not the other way around.
Who do you look up to and learn from in venture, Oren? Like, for me, Chalfant's like my papa.
I don't know that there is any individual at this point that, and frankly, I don't know that I don't know that there is necessarily an individual that, like, generally, I would, but there are many people that I think very, highly of. They did things that I couldn't have done. It's a different game. I couldn't have built an Andreessen Horowitz. So I think it's admirable that what these guys have built. And for sure, for example, I did learn, just to pick one person, Ben Horowitz. I did learn things from his book, more than operational side, which is something that he's much stronger than I am about. So maybe that's an example.
What's the most memorable first founder meeting you've ever had, Oren?
The most memorable first.
It's a brilliant laugh.
Oh no! I'm really trying to. Maybe I would say. You tend to remember more the first meetings that turn into great outcomes, like the first meeting with Audible, the first meeting with Houzz, the first meeting with, I would say probably I tend to remember those, not because something specific necessarily, but because, there was magic, there were, there were, in all these cases, like I immediately, like within 24 hours, I made the decision. In the case of Audible, I still needed a few, some time to, because I needed to get it approved because I was still at Apex. But with the others, it really within less than 24 hours.
Penultimate one. What's your biggest insecurity as an investor today, Oren?
What is my biggest insecurity?
Yeah, as an investor.
As an investor. Yeah.
I do love you.
I don't know.
So, like, I always have this insecurity that, like, yeah, the media company's like a 10 million plus revenue business now, and I've built that from nothing, but I'm not technical in any way. I have insecurities about my technical complexity.
From that perspective, I don't have insecurities. I feel very secure now. It's been 27 and a half years that I've been doing it. I think that, the results speak for themselves. And it's not that I'm it's not that I'm an expert in everything. In fact, I'm an expert in nothing. So any parts of this job, you could find people who would do better than me or would know more about it. Any domain, I'm never the domain expert, but I don't feel insecure about it because I think overall, I think that I feel very, very secure about my ability to make great decisions and to be a great partner to the founders. There's always the fear of missing out. If something, because it would bother me to miss out on a great outcome. But it's not something that actually I think of or about or preoccupies me at all.
Totally. I think it should always be a consideration, so totally with you there. Final one for you. What's the most recent publicly announced investment, and why did you get so excited?
Again?
Yeah.
What was the question? I know I couldn't hear you.
What was the most recent publicly announced investment, and why did you say yes and get so excited?
First of all, I don't remember what was because I make so many investments. I don't remember what was a recent. Let's find a recent. I don't know what was if it's the most recent. Riverside is the recent one. Let's use Riverside. So I saw them a year and a half ago in September, maybe August 2020. And at the time, and you remember it well, it was a very, very, very basic. By the way, I saw them and on Zoom, and 2 hours later, it was too late to call them because it was for them. They were in Europe and Israel. And I sent them an email that I want to do it. Let's talk tomorrow about the terms. And the next day we agreed on terms, and I did it. I did it at 7.5 pre-money valuation. What got me excited?
Yeah, what did you see that I didn't see?
Yeah, so I think it's the opposite. I think you may have seen more things that I did, which made you not want to invest. And sometimes it's better not to see some things. But what I did see is I saw a very basic product with a lot of unstable, buggy, very little technology. The whole thing was written by, the whole code was written by Gideon, the younger brother. And they also had very, very loud, very high churn at that point. However, without any marketing or sales, they were getting 5 to 10 people a day to sign up and pay $40 a month, which again was too high a price. So, and you don't get, without any marketing and sales, you don't get 5 to 10 people, totally word of mouth, pay $40 a month if there is no real need for something. So the fact that the product is buggy is not a big problem because it can be fixed. The problem that that's basic, okay, they'll add to it. But to me, it was very clear that they stumbled upon a real product gap, a real need for something like that, because otherwise they would not have got the traction that they had for such a buggy and such too pricey and without any sales and marketing.
7.5 pre, Oren. I didn't know it was that.
And 10 pros. And it's always better to start with. It's so much more important to identify the problem correctly than the solution. So even if the solution was very imperfect at that point, understandably, Gideon worked on it for 6 months. I don't know how much how long he worked for. It couldn't have been a lot at that point. But if you identify the problem right, you can build a solution. If you missed characterizing or identifying the problem, it's not gonna help that you have the best people and you write the best code. It's just not gonna. You're just gonna, miss out on the opportunity. So that one. So the announcement, the recent public announcement is recent. I decided to. They haven't burned much money actually. They hardly used any cash. They did do a SAFE a few months after I invested, but they haven't even used most of the SAFE money. And then then we started talking about maybe I'm going to do a round, and that was their preference that I did it. And we agreed on a price, which was probably the highest price that I would have been prepared to pay, and probably the lowest that they would have taken without, going and testing the market. And so I did this round, and I feel very confident that this is going to be a huge outcome, way beyond what it is today.
Fuck.
Sorry to rub it in.
No, Oren, listen, you were brilliant. You showed it to me. You were supportive, as always, and I learned a big lesson there. Listen, Oren, I always learn from you. I always love our chats. I can't thank you enough for doing this. Next time you come to London, hang out with me and Chalfen. We'll take you out. But listen, I loved it, so thank you so much.